Okay, so welcome back to the Princeton Initiative 2020, Macro, Money and Finance. What I will do today, yesterday we covered already a model, a real model without monetary aspects and without money. Today I will introduce money, and yesterday we had two sectors, so I will simplify the model, treat a very simple model where we have only one sector. And I will present a paper which is called the Fiscal Theory of the Price Level with a Bubble. So it's a particular model, which, you know, the baseline model we have is you can view as a workhorse model. You can use it for many, many different things. Okay, so that's why I would like to teach you this model. You can actually solve it in closed form, so you can build many bells and whistles onto this model. So here is what I want to do. So today, I will emphasize four roles of money. You're all familiar with that. You have a unit of account. You know, it makes a difference whether there's a common unit of account we agree upon. It's an intertemporal thing. So you have a numeraire. That's typically we need for bounded rationality. You know, if you have measure temperature in Fahrenheit or in Celsius, you have a different sense for that. That's a more behavioral story. And also for price stickiness, that's a story you can have. And then there's the store of value thing, and we will focus very much on the store of value component. And that's what I want to teach today, is the I theory without an I. So what does I mean? I stands for intermediary, stands for another banking sector, and we don't have a banking sector in this model. So it's a very simple model, but the advantage is that you can, you know, solve it in closed form. And so far we had no idiosyncratic risk. So the new element we introduce now is that if you invest in capital, it's your own factory, your own shop, you have some idiosyncratic risk to bear, okay? And then we link the whole thing to the fiscal theory of the price level. And I will tell you what it is. Most of you might know it already, many might not know it. That's one of the different theories of money. Of course, there's quantity theory, monetarism on the one hand, and the New Keynesian approach. The fiscal theory focuses very much on the government debt, how the government debt level more generally affects the price level, or also the inflation, a change in the government debt, how does it affect the inflation? And the medium of exchange role of money, that's where the quantity theory comes in. So monetarism focuses much more on the medium of exchange, where there's double coincidence of wants. And if there's time at the end, I will put the medium of exchange role of money into this whole thing as well. Of course, money is memory. That's a big insight. And it's a record-keeping device. You know, who is contributing what to society. Prices might not be fair. So some people get too little, others get too much money. But it is our main record-keeping device. Who is contributing what to society. And if you think of our wallets, it's a distributed ledger. Everybody has a little piece of this inside of this wallet. And that's, you know, nobody sees all the wallets in the universe. But if you put all the wallets together, all our wallets, we would know how much money everybody has. Okay, that's also a ledger. I will not go into these details of monetary aspects. I will focus much more on the store of value aspect and the important role of debt contracts, the intertemporal thing. The financial frictions will play an important role. So I will not touch on this price stickiness. All prices will be flexible. You can add this later on in this framework, but today I will not focus on that. So it's not the traditional New Keynesian framework. It is more the store of value perspective. So where does it fit in the bigger picture? There are many papers on the money or the government debt as a store of value, as a safe asset in a sense. And you're all familiar with the OLG framework, Samuelson's famous OLG framework from the 1950s, where essentially he introduces money, and money is essentially opening up trading across generations. There's the young and the old. They essentially want to consume all what they have. If they have money, they can pass it on to the newborns and get resources from the newborns who have some labor abilities. And then essentially you can actually transfer resources through generations, which you cannot do with money. So essentially by having money, you open up some trading possibilities you can't have otherwise. And then Peter Diamond essentially introduced physical capital in this model. In Samuelson, there's no other store of value. So money or government debt acts as a store of value. And then Peter Diamond actually added the capital component to it. And we all, I guess you're all familiar with this classic model. That's one type of models where it's all about the OLG structure. That's where the friction essentially is, if I want to call it friction, but the friction essentially is an OLG friction. So that's what's going on here. So that's the OLG friction. Now, the other friction we will focus on is incomplete markets, okay? So we have financial frictions rather than OLG frictions. Let's focus on incomplete markets, and we will add idiosyncratic risk to it. So the idea is that there's idiosyncratic risk, and you cannot really share this idiosyncratic risk because you run your own restaurant. There might be more demand, less demand, but you cannot really sell off this idiosyncratic risk to the financial markets. And of course, there's a whole literature on this where in the idiosyncratic risk is mostly endowment risk, for example, labor risk, and you attach a borrowing constraint to it. Then you have this Bewley type models, okay? So Bewley is essentially the same thing what Samuelson did. There's only money in this economy. There's no physical capital. So the only store of value is money or government debt. But it just does it with a different friction. Instead of OLG, you have it with incomplete markets, okay? Now, what Diamond did for the OLG model is what Ayagari did for the Bewley model, okay? Ayagari introduced physical capital, and then typically what happens, you introduce physical capital is more productive, and because physical capital is more productive, it crowds out the money, okay? So nobody wants to hold money because money doesn't pay any interest. Okay, that's what Ayagari did. He did essentially similar things what Diamond did to the Samuelson model. Ayagari did to the Bewley model, or later Huggett, with an explicit Bewley model without physical capital. Now, this is where the endowment risk is. What we are doing is something similar, but we do return risk or investment risk. What's the difference? The endowment risk doesn't depend on your portfolio choice. The return risk, if you invest more in your little shop or in your restaurant, your risk goes up. So an endowment risk is independent what you do on your investment, okay? The return risk means you have a safe asset, the money or the government bond, and then you have your own additional shop. And if you invest more of your wealth into your additional in your shop, then actually you have more risk, okay? So the risk is associated, portfolio choice is affecting your risk. And the assumption is that the risk is tied up with your individual capital. So what's your capital in it, okay? That's what we call this I theory without money. That's actually a paper we wrote in 2016. It's a simplified version of the I theory because there's no intermediary sector. It's only one sector. There's no banking sector. It's in AR Papers and Proceedings 2016. Okay, so that's how it falls into the literature. Let me just set up the model then, and you will be familiar already from yesterday's lecture what's going on in this setting. So we have agents, but we have only one type of agents. So we don't have experts and households or the financial sector and households. No, now it's actually the case that we have very much only agents, and they're all the same. So they all have the same utility function, they have the same preferences, all have the time preference rate of rho, and they all have the same production technology. What's new now is that they have little i's, superscript i's, and I put a little bit tilde on top of the I, indicating that there's also idiosyncratic risk, okay? So there's only one sector now, but within this sector, we have different agents, a continuum of agents, and we always denote them with I tilde. Okay, because the tilde is reflecting. And importantly, like yesterday, the capital stock evolves. The change in the capital stock here in percentage terms is the investment rate. So if the investment rate iota is going up, which can be I tilde dependent, that's our adjustment cost function capital phi. Then we have the depreciation rate delta, and then we have some aggregate shock, and then we have some idiosyncratic shocks. Okay. We can solve it with aggregate shocks. I'll show you later. It's actually fairly easy in this framework, but let's focus today only on idiosyncratic shocks, okay? So everybody's focusing is getting his own idiosyncratic shock, and idiosyncratic means you put a little tilde on top of the DC term and this I tilde term. Okay. And what's the financial friction? The financial friction in this framework is that you have to bear the idiosyncratic risk on your own. Okay, you cannot sell it off. That's a big assumption. Okay, so you cannot sell off this this friction or this idiosyncratic risk. So on top of it, there will be a government because there might be government bonds issued. So you can switch off certain things. So if you look at the goods market clearing condition, we had like yesterday, A minus iota times K. So remember we had this, how many did we say? We had 30 apples produced and 3 we replant for new trees. So that's essentially what this term is, supply of apples. And that's what the consumption is. But now we also have a government who might consume. And the government consumption as scale, so the script G here is essentially a scaling factor with respect to the capital stock. If the capital stock in the aggregate economy is larger, also the government will consume more. But for today, let's just switch off this G as well. Okay, so the government is not consuming anything. But in theory, the government can also take some of these apples and do something or tax it or do something with it. Okay. Now we have to talk a little bit about the government. So let's look at the government, what the government can do. It can actually, that's what the government can spend on. And you can assume that the people get utility from the government spending. We assume they don't. Now you just throw, government is taxing, takes apples and throws it into the sea. So it's totally wasted. That's one way you can view that. We can also put this G equals to 0. Okay, but what we're really interested in is the government is issuing bonds or issuing money. Okay, that's what we are really interested in. And the debt supply essentially is given by this. So there's a certain growth rate, mu B, that's the growth rate of the debt supply. And they could also, in theory, it could also, on the aggregate shock, it can react to aggregate shocks. If there's an aggregate shock, it can say, oh, whenever there's a negative shock, we will issue more bonds or fewer bonds. Okay, that's the sigma B. Okay, for today, I will not focus on the sigma B, but you can also incorporate this in the sigma B. And that would be very powerful in terms of monetary policy. You can say, oh, whenever there's a negative shock, there's a hard Brexit instead of a soft Brexit, we will issue more bonds and create a little bit of inflation, but to smooth it out among the citizens better. Okay. So, but we'll come to this perhaps later, but not necessarily today. And then the government is also paying some interest rate on these bonds, and it can, tax output with tau, and it can also impose lump sum taxes if it wants to. Okay, but let's just switch this off. That's a budget constraint. There's a government budget constraint where we have say, okay, the government has to pay some interest. It has some expenditures. These are real expenditures. So B is nominal. So we have to put times the price level to get the nominal expenditures. It can print more bonds. That's the growth rate of the bonds. So it can print more bonds. It can tax to fund the whole thing. So it's funding output. Remember, A times K is the output of a single guy. A times capital K is the output of the whole economy, including the reinvestment, and it just taxes a tax rate of tau. Okay, times script P, the price level, makes it the nominal thing. And then you also can have this lump sum taxes if you want to. So let's just assume this script G is fixed. So proportional to the size of the economy, the tax rate is not moving around. There are no lump sum taxes. And let's also assume for today that the growth rate of the bonds is a fixed number. Okay. So typically, when you print bonds or print money, you get resources. And the question is, who is getting these resources? Or put it differently, what is this tax rate? So I should have said, when I go back to this, there's this tax rate, tau. So we forget the lump sum taxes, but it could also be negative. The tax rate can be negative, so then you get a subsidy. Okay. So I put this tau on output, which means you get a subsidy on output if the tax rate is negative. Tax rate is positive, it's a tax. But generally, there could be some seigniorage created from this money printing or this bond printing. So money and bonds printing is here the same, so we don't distinguish between the two. And I will come to distinction later on. So if you were, whenever you print new money or print new bonds, give it to the bondholders or the money holders, it is actually having no effect because there's no price stickiness in this model. So if I say, okay, I print just money at a higher rate, and this new money I print, I give to the money owners, it means you create more inflation, but you compensate everybody with higher interest payment, let's say on reserves, to compensate for this high inflation. So it's super neutral. So this economy is super neutral in this regard. Okay. So if you just print more bonds or more money and give it to the money owners, holders, or bond holders, then it doesn't do anything. Okay. But if you give it proportional to the capital holders, that's what we do here is this tau was multiplied by A times K. So if you have a higher K, then you actually get more. If you get seniorage, you pay it out, you give subsidies or you tax. Then it makes a difference because it will change the portfolio choice. Okay, when you make a decision, you always make a decision: should I give some more? How should I make my portfolio? Should I put some of my wealth more in government bonds and money, or should I put it more in my little shop, in my restaurant, or some other capital investments you have? Okay, and that depends how things are taxed. So, for example, if there's a lot of inflation and there's a lot of money printing and bond printing, and it is transferred then to the capital owners, then I essentially have an inflation tax on money holding, and I subsidize capital holdings. And this will affect my portfolio choice. Okay, so the portfolio choice is a very, very important component to understand this. Okay, so if the money return, if there's a lot of printing of these bonds, so the change in money supply or debt level is growing fast, and it goes primarily to the capital owners, then the capital return will increase. Okay, that pushes the citizens to hold more capital. Now you can also say, instead of giving it proportional to the capital holding or proportional to the money holding, I can also give it proportional to the net worth. Okay, so there will be some of you guys who have experienced positive shocks, a lot of positive shocks, and they will say, okay, they will be wealthier than I am. They're 10 times as wealthy as I am, and because they're 10 times as wealthy, it will be the case that they also have the chance to everything scales up in this model. So I mentioned this yesterday. Within a sector, if somebody is 10 times as wealthy, he does 10 times as much consumption, he does 10 times as much investment and everything. But in terms of ratios relative to his wealth, everything stays the same. So the investment rate, the consumption rate as a fraction of his wealth, all of these things will stay the same. Okay. Now coming back to this, so I can give it proportion to the money holdings, I can give it proportion to the capital holdings, I can give it proportion to the net worth. But giving it proportion to the net worth is like a combination of these two. I give part of it to the money holders and part of it to the capital holders. The part I give it to the money holders is neutral. The part I give it to the capital holders is actually pushing the portfolio choice towards capital. Okay, that means if I give proportion to net worth, I still push it towards subsidizing capital. Do you see? Because this is neutral, it doesn't do anything, number one. Number two, pushes towards capital. I issue bonds and give subsidized capital holding relative to, because I have to have an inflation tax on money holding. Having this proportion to net worth, which is a linear combination of the two, is essentially giving it to net worth. And I can also give it forth per capita, but per capita actually is also no real effect. It's a little bit more difficult to see. So let's suppose we're equally wealthy at this point. If you give it a wealth to per capita, I can expect essentially in the future that I will get some payments from that, and I can trade on it. And this, the future seniorage revenues I will get will be already discounted in my wealth. So I take it already in my wealth into account. Okay. So there's no real effects because people simply borrow against these transfers they expect to receive in the future, and that's essentially makes this whole thing mute, so it doesn't have any impact. Okay, so with this, so let's follow the same step procedure we did always. Okay, so remember what was step number 0? Anybody?
Reporting the processes.
Exactly. So it's always a big advantage to be able to read these things. So that was step number 0. The step number 0 was let's postulate the aggregates and the processes. So what we have now, we have actually the value of all the physical capital. That's QK times K. So I put a little superscript K on it to show that's actually price of a machine is not QK. Okay. Now I also have the value of all the bonds. Okay. So what's the value of all the bonds? That's capital B. Okay. But it turns out it's easier to work with if we call it, if you scale it as relative to K. So essentially the model is set up that everything is scale invariant with respect to capital K. Okay, so if you have two economies, you have the US and you have Germany. US is 3 times as large as Germany, let's say. So what they differ is in K, and if they experience the same sequence of shocks, everything will be similar, will be identical, except that the US is always 3 times as large as Germany. Okay. So that's what we can scale it, and the variables we deal with, we don't, the K, we will have to follow to what's going on the K, but we can move it out and solve it separately, okay? And you will see it because the K will only depend on the investment rate, how it moves. And once we have solved the rest of the system, we can solve for the investment rate, and then we know what the K moves, but so we can separate it, the solution steps in this regard. There's a wrong notation here, this P here, that's old notation, should be QB, okay, this P here. Okay, so there is the value of all the bonds, and the price level, essentially, you can think of as the value of all the bonds divided by QB, the real value of that, okay? So that's the nominal value. The nominal value of all the bonds divided by the real value of the bonds, that's the price level, okay? So put it differently, I should say differently, this QB times K, what we have over there, so I don't know how to reach that most efficiently. So QB times K, that's the real value of money. Or think it differently, think of a bunch of gold. If the only thing we have is a bunch of gold, and gold has no intrinsic value, there's the value you attach to all the machines, there's QK times K, and QB times K is essentially the value of some pieces of paper the government gives out, or the gold the government, the gold which is floating around, but it has no intrinsic value. You don't derive anything from that. It only is a bubble value, and we will see that, okay? And that's how we denote the real value of these government bonds, okay? And think of a world where the government says, I just issue some government bonds, I don't impose any taxes, and I just continue issuing these government bonds, and that's all what we are doing, okay? And you can use this piece of paper to do something with it, but don't never expect anything in return. There are no taxes, so you never pay any taxes. That's, the government bond is just there. You can use it as a store of value. Okay, is this fair? Then I denote something like var theta. That's the value of the government bonds, or this money, divided by the total value in the economy, which is the value of all the physical machines plus the value of these government bonds. Okay, that's what I call var theta. You can think of, that's a fraction of the wealth in the economy which is due to is driven by some nominal, some government bonds or money and things like that. Okay, so QK times K, that's the wealth of all the machines. They have future cash flows that create something in the future. QB times K, That's the real value of money floating around, okay? And so as we said, we have to postulate step number 0. That was just some definitions. With step number 0, we have to postulate the price process. And what we do now is we postulate the price process for QK. That's the same. We have a certain drift with subscript T and a certain volatility with subscript T, okay? Loaded on the aggregate, there's only one aggregate Brownian dz. Of course, there are a lot of idiosyncratic Brownians. Each guy gets an idiosyncratic dz tilde, okay? So we still have that, but they're all wash out. They don't affect the aggregate prices. That was one of these misleading problem sets we had. And then there's the price process for QB. That's essentially QB that also has a certain drift. So it's a different drift. And it has a certain loading on the same Brownian. That's the Brownian here. Okay. And then we have to postulate a stochastic discount factor process. That's a stochastic discount factor process. And remember, we said we always put minus signs there because we know already the drift of the stochastic discount factor will be the risk-free rate. And then there will be a price of risk. So the loading of the DC term we call minus var sigma. This var sigma will be the price. For now, it's just postulated. And there will also be, because now this is the stochastic discount factor of a single guy, an I tilde guy, there will also be some idiosyncratic risk. Okay. So this is also loading on for the single guy. It's and all Brownians are independent. Okay. So the loading on this single guy's Brownian will be called var sigma tilde. This will be the price of idiosyncratic risk. Okay. And here's a little question. I think we dealt this already last time, so I will not introduce this poll question here, except if you want, but it's a little bit too trivial at this stage. Are there questions about this?
Yes, Marcus. Here you're assuming that there is no aggregate risk, that dz is 0, basically, there is no dz.
Oh, yes. So later on, I will switch off the DC term. For now, I carry it with me. Okay, so you can, it's very easy to carry the DC term with us. At some point, I will drop it to keep it simpler. It's just the economic interpretation is simpler when it's a good observation. Typically, we have to carry it with us because there's aggregate risk floating around. And it's more interesting as an economic problem, especially in finance, to have aggregate risk. Okay, good point. Any other questions?
Yes, Marcus. I was just wondering concerning, like, if we have aggregate risk, is it possible in the data to identify the stochastic part of the monetary policy? It seems hard to, like, I estimate like the volatility associated with that.
So essentially, yes, you can estimate it in a sense that is saying how much does monetary policy react to a negative shock or to a positive shock. So you have to estimate the reaction function. Okay, so think of the aggregate risk is destroying some of GDP, permanent destruction of GDP, and how does monetary policy react to it? This would be the sigma B. That's what you're referring to, no?
Yes, yes. Okay.
And that's, you know, there's a negative supply shock, COVID, suddenly monetary policy is becoming very loose. That would be very, and then there's a productivity shock, which is very positive, monetary policy would tighten. That would be the sigma B.
Okay.
This sigma B I switch off for now, but you can see it's very relevant. It's for in understanding monetary policy. Okay. Here, in the beginning, I mix fiscal and monetary policy. Whether you print money or print bonds is the same. Okay. I don't make a distinction between printing money and printing bonds.
Okay.
Any other questions? It's good to have some questions because then it shows a deeper understanding what's going on.
So I have a very quick question, Marcus, related to the last point that you just touched upon. Having fiscal and monetary policy to be the same, is that an innocuous assumption? Like how innocent is that assumption?
No, it's I think it's a first benchmark. What we will do later on, and not in this, if you take the course, we'll make a distinction in fiscal and monetary policy There are some monetary policy which always has fiscal implications. So if you do monetary policy with certain seigniorage implications, then it's not clear what it is. So most policies are not clearly assigned in theory, or in practice they just pretend they're different. So most monetary policy moves will have fiscal implications, and then it's a question, how do you label them? But you can have some monetary policy moves in a richer model, which we'll cover in the course, where there are no fiscal implications, no direct fiscal implications. Of course, to stimulate the economy, and this also brings more tax revenue and all other things, but the direct implications have are not of the fiscal nature, so they're budget neutral in a sense. In this class, in this simple model today, it's hard to distinguish whether you print money which people use as a store of value, or you print government bonds which people use as a store of value. It's the same thing. We treat government bonds and money the same way. Okay. We also here we say, oh, the government actually can pay interest on money, which they do now by paying interest on reserves. Okay. And we don't have a banking sector in here, so that makes it harder. So in the other model, we have a banking sector to say our reserves are different from government bonds because only banks can hold reserves, while citizens can't. Okay, but in more general, I think it's.
Can I ask a,
sure. Brenda?
Can I ask a quick question on that? Yeah, so if there's a difference between printing money and printing government bonds, how are the results going to change? Are we going to have two processes, one for bonds and one for money, and then?
No. We only have one. It just is an interpretation of the variable B. You can call it money, or I can call it government bonds.
Yeah, but my question is, if I want to distinguish between the two, how will it change?
So if you want to distinguish between the two, you could say, for example, one is good as in alleviating an additional constraint, like a double coincidence of wants constraint, like a cash and wants constraint. So money helps to alleviate that, while the government bond does not. Hence, money will pay you a lower interest rate because it gives you this additional advantage. And at the end, I have slides where we do this distinction. And then you can make a distinction between the two. Okay, but if I treat money as a store of value and I don't have this double coincidence of wants constraint in it, or cash and wants constraint, or whatever you want to call it, then, or money utility function, then they would be the same. So for example, if you say money is in a utility function, but government bonds are not in a utility function, then there would be a wedge opening up between the two. But it's not clear why one would be in a utility function and the other one not. No. But you could argue that, you know, official government money, you can have to pay something on the street. You cannot use government bonds to pay on the street. So there's an advantage from that. But as we go to a digital currency and all this, the difference is much more blurred. These days, you get interest payments on reserves as you get interest payments on the government bonds. Everything moves digitally, then it's more a difference in maturity. In the other model we will do in the course, we will have long-term government bonds and short-term money. So there will be difference in maturity, but not such differences which die out as we move more and more in a digital world.
Got it. Thank you.
Okay. So let's just understand the returns on these bonds or on this money in a world where the sigma B is switched off. And one way to see that, I didn't change the notation. So this QB is what we used earlier, this little p here, okay? That was our old notation, so it should be QB. And this is essentially what it is. So let me just give you some idea. So let's suppose the economy is growing at a rate of 3%. So this K is growing. So recall, this is the rate at which an individual capital stock of an individual guy is growing. The aggregate economy, I integrate over all the citizens in this economy, and then the idiosyncratic risk washes out. No? So essentially the growth rate in this economy is given by this expression here. And here I got rid of the aggregate risk. Okay, I could have put an aggregate risk term, then there would be the aggregate risk there as well. Okay, and And then if the economy, let's say, grows at a rate of 3%, but the money supply or the bond supply grows at the rate of 1%, then there would be a 2% deflation. No? That would be the return of this money. Okay. Also, if the government says whenever we print money at a 1% rate, we pay it in form of interest to the bondholders, then you also get this interest payment here. So the return on the bond is essentially the return you get paid on holding these bonds, the interest payment, and this is the change in the value of money. Remember, QB times K, so this P should be QB times K, that's the real value, divided by the nominal value, that's the price level, okay? So that's essentially a change in the price level. So this term is inflation, okay? Or the negative minus inflation, okay? So what you get is how much does the real value of money change, and how much does mu b is the growth rate of the bonds minus the interest you get paid on it. So let me just illustrate this more clearly. The return you're holding, what's the real return of holding a government bond or holding some piece of money? What's the real return on that? And I don't know how I can make this camera sharper. Okay, I have to wave occasionally. There is, when I print more bonds, okay, I dilute the bondholders. Okay, so, but if I pay the interest on the bonds, I benefit the bondholders. Okay, so if I print my bonds and pay everything what I newly print, the new bonds, I print money, I pay it on the bondholders, but then this washes out. But if I print a lot of money and I only pay a little bit, let's say nothing to the bondholders, that's an inflation tax. Now it increases the inflation tax. Do you see that? So that's this term. And I call, what really matters is this difference. It's not how many bonds I printed, what growth rate I print the bonds, this mu b. What really matters is mu b I print and I don't pay the bondholders in form of high interest. Okay, that's what really matters. That really reduces the real return on the bond holding. Okay, that's my real return on the bond holding. Okay. And then have something, let's suppose this is 0. Let's suppose the government is not printing. So what's the real return on bond holding if the government is not printing any bonds and is also not paying any interest on bonds? What's the return? What's the real return on these bonds? Is it 0 or not? According to this formula, it's not 0, but why is it not 0? Does anybody want to say something, or just to get a little bit of interaction going in our class? Second? How's it?
That's the drift, right? Drift part, normal drift part is the ethos process drift part. So
yes, so this is like this capital gains on money holdings or on bond holding. What does it say? Let's suppose this PT or this QB is fixed. Let's suppose the bond price is not changing. And the easiest way to see that is that, so we don't print any new bonds, we don't pay any interest on these bonds, and we don't do anything, but the economy grows at the rate of 3%. Okay. But the bonds becoming scarcer and scarcer now, because the economy, we all get wealthier by 3% every year. And what will happen is the real value of the bonds will go up over time. Okay. So there will be a 3% deflation. And a 3% deflation, if you hold a bond, you got no interest or nothing, but you have 3% deflation. That means the real return on the bonds is 3%. Okay. So that's essentially your deflationary component, which comes from the growth rate of this economy. Should I say this again, or is this obvious?
Yeah, it's a deflationary or inflationary, because you are saying 3% growth, right? So
it's deflationary in the sense that if I keep the money supply fixed or the bond supply fixed, so I keep the bond supply fixed all the time, and then I keep the economy growing at 3%, you can see that the bonds become scarcer and scarcer over time. So the real value of the bonds is increasing over time. Okay, that's deflation. It means the nominal thing is getting more valuable over time. So there's deflation. And that's this term here. Okay. Or put it differently, perhaps it's more plausible if I make it in terms of gold, because that's very clearly gold does not pay any interest. So this I is not there. The gold supply is not changing. This mu B is not changing. You don't derive any pleasure from this. So don't listen in India because they like gold a lot. So they don't get any pleasure from gold. So you don't dig new gold out. So let's mu B is 0. So this term is switched off, this last term here. I don't know what's going on. Oh, yeah, I have to wave occasionally. So somehow today the camera doesn't like me.
I have a question, Markus.
Yes.
What is the interpretation of PT again? Is it the price of a bond with one notional?
No, PT or this QB, which should be the new notation, it's easier to interpret that PT times KT is the value of all bonds. Okay?
Okay.
So it's easier to interpret that. That's the real value of all bonds, or the real value of all gold, of all money supply. And I just want to be able later on to descale it. So it's an artificial variable, but it's easy to solve the model with this artificial price attached to it.
Okay.
So it is the value of all the bonds per unit of K. No, that's,
okay. So I mean, it's QBT, not PT. That's why I got confused. It's actually QBT.
Yes. So this PT is the old notation. I apologize for that. So this should be QBT. And but the combined this PT or this QBT plus times KT is the value of all the bonds, the real value of all the bonds. And you can see that if the economy grows at 3% and we don't print new bonds, we don't provide new gold, then actually the value of this thing is going up at 3%. And that's what essentially this term captures. And this term captures if you print more, of course, you deflate it. So the real return on money is going down, on bonds is going down. If you pay interest, so it's minus and minus, the real return goes up. Okay. So essentially that's summary. And I call this mu B check. What really matters is the difference between printing and paying on the bonds. Let me just give this a new name, mu B check, because this always shows up in together. So I'll just give it a different name. Okay. And this here, this I can just use my Ito product rule. Now I have the growth rate x the drift of K. What's the drift of K was this term here. No, the first two terms. That's I got from up here. That's the drift of little k's, but it's also the drift of the capital K, the aggregate K. Then I have the drift of P. That's this guy here. And there's potentially then, and you will see later on, there might be some co-movement between the two. Okay. So there should be some Ito term between the two sigmas. Okay.
Markus, just a question.
Mm-hmm.
I don't know if it's a bit anticipatory, but is it possible in this model to have a value of the bonds that is in real terms equal to 0 and stays 0 if we don't pay them a real interest?
That's correct. Yes, there's one equilibrium. We will come to that. There's one equilibrium where money is worth less or bonds are worth less. You can have that equilibrium too. It's the same as in Samuelson. No? You can also have the government bonds are worth nothing or money is worth nothing, and that's an equilibrium. So there's a lot of analogies to the Samuelson's model. That's a good point. Okay. So this was the return on capital. So we have to, in order to do portfolio choice, we have to figure out what are the two returns, the returns on bonds and the returns on physical capital, okay? The return on the government bonds depend on the growth rate of the economy, and they depend, to what extent this inflation tax. Let me call this inflation tax because you print new bonds and you don't pay it to the bondholders, okay? There's mu check. That's this mu b with a little check on top of this mu. Okay.
Excuse me, Marcus. I have
Yes.
one question regarding aggregation. Okay. The investment function depends on iota. Iota is here the same for every individual?
Yes, yes. In this model, we have one sector, all ratios, so all investment rates, everything will be always the same. You will be 10 times as wealthy as me, but you invest 10 times as much as me, but per unit of capital you have, we both invest at the same intensity. Okay, so that everything is set up, that everything aggregates up very nicely in this economy. There are no aggregation issues. Okay. That's why at the end, we will have 0 state variables in this economy. You know? We can solve it fully. There's not a state variable going on, except for this capital K. But we can solve this capital K. Once we know the iota, we can solve it outside of the main model. Okay, are there any other questions? It's good to have questions. So that's the real return of the bond or the money. That's what's given here by this equation here. Okay, that's what we have here.
A quick question here. So what stops me from choosing investment rate unbounded here and like making that grow as much as I can?
You individually? So we haven't solved this. So what stops you is this concavity of the phi function. So essentially what you do is you take some apples and plant new trees. So the first apple you plant will produce a very likely a tree, but the 100th apple you plant will very unlikely to grow into another tree. Okay, so that's because of this concavity. And you all face the same concavity, so the optimal iota for all of you will be the same. Okay, and this iota is the investment per capital unit you have currently. So it's an investment intensity given your existing capital stock. Does this answer your question?
Yes, thank you.
Okay. So it's a concavity in this phi. But that's, you know, if you go to any macro models, they all have the same phi. Typically they have a quadratic. We have this log specification as we saw in one of these problems you did in the morning. Okay, so we have done the return on money or on the bond. We also have to do the return on capital. And we did this already yesterday. It's the same. The only thing which is new is that we have now a tax rate on the output. So you have A times K is your real output, and you will be taxed at the rate of tau. Okay, you can put it to 0 if you don't like their taxes. Okay, but otherwise, do you recognize this from yesterday? Same thing, no? The only difference here, now you have idiosyncratic risk, so I switched off the aggregate risk. So the only is that there are tildes on it. Okay, and then there's a little iota tilde over here because it's different. Everybody has potentially the same expected return, but different realizations. Okay, because depending on how your restaurant is doing relative to my restaurant. Okay. And then I also have a budget constraint for the government. That's, you know, it taxes something. That's what the government takes in. It gives some government expenditures. But we can switch off the tau if you want today, and we can also switch off the government expenditures. But it also, from printing money, it can generate some additional, it can balance its books. Essentially, it has to, if it doesn't balance its books with taxes, the expenditures go beyond the taxes, it has to print some additional bonds or issue bonds or issue money. Okay. Now, because of this government printing, the whole return on capital is a little bit more complicated than yesterday. Okay, so let's just go through this again. So we have a dividend yield. So the dividend yield is given by this. So the return on capital, you have the dividend yield like yesterday. So this was A minus iota. Now, if you know, the government is taking something away. Okay, so there's something going away from and I call this this A check again, because this G, set this G to 0, and then we have just this A what we had yesterday. Okay. Now, if the government is printing money or is printing bonds, and I mentioned this earlier, it is de facto subsidizing capital. Okay, so what the government does, it is printing bonds, and with this, it creates some seigniorage, and then it gives this money back. It can do it directly to the capital owners, or it can do it to the proportion to net worth. But in both circumstances, it will actually subsidize capital and tax money holdings. Okay, and that shows up in this term here. You see that? That there was this mu b check, because what matters is this difference in taxation. So in a sense, if I go back to the previous slide, the bond return is taxed. That's the bond return is taxed, and the capital owners, they're subsidized. Okay, and then this P, this should be, that's the old notation, P over Q should be QB over QK. Or just depending how much you can subsidize in tax, depends on the ratio of relative capital and wealth in this. And then, of course, you have the capital growth rate. That comes, the capital gains rate comes from the drift in K plus the drift in Q. Okay. And then you typically, you could also have an eta term, but in this setting here, the Q is actually not jumping. So that's why there's no eta term here. Okay. And because I switched off the aggregate risk, so we don't have any sigma Q. Okay. You have only idiosyncratic risk, so sigma Q would be 0. So this eta term is not showing up. And then we have this idiosyncratic risk U phase. So that's your return on capital. Other questions about this? Anybody? No. Okay, so now the household's problem is essentially the following. Perhaps I should have started this way. You have the net worth, the percentage growth rate of the household is the net worth of an individual household I tilde is this. It consumes or minus. So if it consumes more, the consumption net worth ratio is higher than it consumes more. Then it gets a return on the bond holding. And then it gets an excess return on the capital holding. Okay. The excess return depends on the portfolio share 1 minus theta. So theta you put into bonds, and 1 minus theta you put in the physical capital. Okay. So I could have written it differently. I could have put a theta here, theta times the bond return plus 1 minus theta times the capital return, but it's often easier to write it in terms of excess returns. Okay. Now, oh, this was moved inside a little bit. Sorry for. Now I have my Bellman equation, the HJB equation. So that's just the rho is my time preference rates. The value function is equals to the maximum of, I have my flow utility. And then I have my plus V prime with respect to the net worth plus a half V double prime with respect to the volatility of this net worth things. Okay. Remember, this was from, this is the eta term here. Okay, that's how the HJB equations always look in continuous time. Okay, that's essentially what you have. Typically is your flow utility plus the expected change in the value function. No? And the way it is in this, it's just the first derivative times the change, and then plus the second derivative because of the eta term. Okay. Now let's, so here I have V prime, then times the change, the change is just given by this, you know, the consumption from this, and then I have n times the expected return I have on the bond holding, plus, you know, 1 minus theta, the expected excess return I have on capital own. And that's what we just plug in, what we have calculated in the previous slide. And then I have this volatility here. And that's how volatile my N is, my net worth is. Other question about this HJB equation? So we didn't, so the alternative would have been, and I'll show you later on, we can also use the marginal method, okay? But here I just use the more traditional HJB approach, okay? So I have to solve here. So I have to maximize here. I have to maximize my consumption, my iota, and my my theta. So these are the three choice variables. So let's do first the iota. The iota is very simple. It's a static problem. So I propose, I guess, and verify a particular value function in this approach. And then this iota is just this Tobin skew, and you've done this. And we assume this particular log adjustment cost function. And then we get this outcome here. Okay, that's, and again, I didn't, this kappa should be phi. We changed notation on this. Okay, so this kappa, whenever kappa appears here, it should be a phi. Okay, so that's the first outcome. The second thing is I can solve for the consumption, and we have done this yesterday too. I can, in general, I can have consumption net worth ratio is rho check, but if it's a log utility, so remember this, we did this yesterday. So recall C over N is just rho 1 over to the power of 1 over gamma times omega, where omega was our net worth multiplier or investment opportunity. And that when gamma is 1, this just becomes rho. Okay, remember that we did this yesterday, a very late hour. And then essentially when we have log utility, this rho check is equal to an exogenous parameter. If you have constant relative risk aversion, it's more complicated. It is, you know, we have to solve it explicitly, and I won't go into this. In the course, we will really solve it for the constant relative risk aversion case. Okay. So the total consumption demand, then if you aggregate up to capital C, is rho, everybody wants to, times the wealth in the economy. And the wealth in the economy is Q times K is the value of all the machines, and P times K is the value of all the government bonds outstanding. Okay. So that's the total wealth in the economy times rho, that's how much they want to consume. So what's the remaining choices left? The remaining choice left is the portfolio choice. Okay. So I have the investment rate, I have the consumption choice, and I have the portfolio choice, and that will be a theta. And I will not solve for the theta now, I just leave it and then impose market clearing already. And the market clearing essentially says that total demand for apples has to be total supply of apples. And I put here the government aspects to 0, okay, already. And then I also assume that the capital markets have to clear, so physical capital, and for everybody it has to be, or if I aggregate it up, it has that the theta has to be equal to the var theta. So remember, what's the var theta? The var theta was a fraction of wealth in the economy, which is nominal wealth, okay? And the theta is the fraction of wealth of each individual he wants to put into bonds relative to his total net worth. Okay. In equilibrium, these two things have to be the same. Now they have to coincide. That's where capital markets have to clear. Okay, so var theta has to be equals to theta. Okay.
Markus, I have a question here.
Yes.
Isn't there any aggregation problem when you go from the single choice of theta to the aggregate choice of theta?
No, yes, so each individual is choosing its individual theta. So perhaps what I should have made here is theta I tilde, but they're all the same because they all choose the same theta. Okay, remember this was all set up in a nice way, constant relative risk aversion. They all choose the same theta. So everybody has a portfolio share, let's say of 30% he wants to put in the government bonds and 70% he wants to put into his own shop. Okay.
Okay, thank you.
And then it has to be the case in the aggregate economy. If I say what is the value of all the bonds relative to the value of the bonds plus the physical capital, it also has to be 30%. Otherwise, the markets wouldn't clear. It's good to ask these questions. Okay.
Markus, I had a quick question.
Yes.
How difficult is it to like add heterogeneity in terms of portfolio shares? So you can imagine that someone's optimal portfolio share might change with the amount of wealth they have. Is that easy to do, or I mean, it's more complicated, but I wonder how often that's done.
No. So that's what we do later on in the class as well. So we have different sectors. You can what we call a sector, you can also have some guys with different preferences, let's say. So we have two types. One type of people who have this type of preference, the other type of people have different types of preferences. And then what matters also the relative wealth share in order to solve it. Okay, you cannot solve it in closed form anymore. This one we can solve in closed form. Once you do that, you know, you have to go deeper, and then, you know, the closed form is gone. But you can still easily go many steps and then you go numerical at the end. And that's what we do when we do the I theory. You can think of the two types of guys, and the relative wealth share matters. And then there's a lot of interesting economics happening as well. Okay. So once I plug in this portfolio choice in more, then what you get is, so now I use this new notation again. The price of a machine is given by this expression, and the price of a bond per unit of capital. So this is a strange animal here, but we express it as a strange animal because you can solve it explicitly for this term. So it's not explicitly solved fully yet because this var theta I haven't solved for yet. Okay. So this var theta is actually not solved for. I will solve this next, but I can show you already that, you know, these two prices, the two key prices, I can solve explicitly, and then out of these two prices follows iota, the investment rate. And iota is then the investment rate, and that actually gives me then some idea how the economy grows over time. Okay. And there's a money-less equilibrium where this var theta, so the value of money is 0. So this var theta would be then also 0. Okay. Oops, sorry, this, yes. Sorry, there's a mistake here. What's white here should be, so it's because I copied it from the old slides, which had a white background and was hidden. Now I copied a new with a green background, and suddenly some white thing appears. So what's white here should not be there. Okay.
I'm sorry, Markus, what is rho check T here? I think I missed that.
So a rho check is a net consumption net worth ratio. And if you have log utility, it's just rho.
But
if you have constant relative risk aversion, it can be some more general thing. Then you can't solve it. You cannot solve it explicitly. With log utility, you can solve it explicitly because it's just an exogenous parameter.
But
if you go more general than log, then you can only solve it up to this consumption net worth ratio, which itself is an endogenous thing. But if it's a log utility, all of these other things besides the var theta, they're all exogenous. So this adjustment cost kappa and so forth, they're all exogenous. Okay. Now, of course, we have to do this portfolio choice, which I was, hiding a little bit, so we can solve it explicitly. And I just give you a little bit the idea what this portfolio choice does, and then we solve it explicitly. But just to get the idea is you have this A minus iota over Q. So that's the dividend yield, what we talked about earlier. And then you have essentially some subsidy or tax on the portfolio, on the risky asset. And then you have some risk premium on the other side. So this is the expected excess return from so you have the dividend yield plus the capital gains and the subsidy component has to be equals to the risk premium. So where do you see this risk premium here? Does anybody see it's for log utility here? Does anybody see the risk premium? So typically the risk premium with log utility is the price of risk is sigma tilde. Oh, it's because we have only idiosyncratic risk, so it's sigma tilde. So that's what is sigma tilde. And then the risk is also sigma tilde times the fraction of your wealth you put into physical capital. Because if you hold money, you don't have any risk. Okay. So only 1 minus theta, that's the fraction of your net worth you put into physical capital, times sigma tilde, that's the idiosyncratic risk you're holding. So that's the risk you're holding. And the price of risk is sigma tilde. That's why there's a square showing up here. Okay. So this whole thing is the risk premium. That's a required risk premium. That's the risk premium you're getting. And the risk premium comes from the fact that you get some dividend yield. If you hold money, you don't get any dividend yield. And of course, you also benefit from these other aspects coming here. So if there's, for example, there's money printing, this mu check B here, that means the relative value that the physical capital gives you a higher benefit. So that's what's showing up here. So let's derive that more explicitly using, for example, the martingale approach. Okay. So one way, and I hope this is not, we did this yesterday. So what we say, what is the expected return on capital? That's just a drift term. It's a dividend yield. Then we had this, so here I've put everything in. We have the growth rate of the capital stock, the expected growth rate of the drift of the capital stock, the growth rate of the price. Then now here I put the Ito term in. And then this should be a B, that's the growth rate of the money supply or the bond supply. And that's this relative value here. That's essentially the expected return on capital has to be equal to the risk-free return plus the risk premium. And here I put everything in. So there could be an aggregate price of risk times the aggregate risk, which is sigma, which we switched off. Sigma Q, if there's no sigma Q. And then there's some idiosyncratic price of risk times the idiosyncratic risk. Okay, so that's, are you all with me on this regard? So we did this yesterday. Just what's new now is that you also want some idiosyncratic risk premium on top of it. Okay, and actually now a simple example I will solve now in the future. This is actually switched off because there's no sigma. Hence, there's also no loading on the aggregate. There's no aggregate Brownian, so sigma Q is also 0. So we don't have this term here. And also this term drops out if you don't have any sigma, no sigma Q. You all with me? Yes. I hope. Now I have the expected return on money or the expected return on bonds. So M and B, that's just we switched notation in the middle. So I shouldn't have apologized for switching notation in the middle. So what you don't get from holding, from capital, you get some dividend yield. From holding money, you don't get any dividend yield. Okay. And that's otherwise, if the capital stock is growing, that's what you get. If the P is drifting, that's what you get. And then there's an Ito term. Again, the sigma is 0, so we don't have this Ito term. And then there is this money printing or this bond printing, this mu B or mu M in this other notation. That's a minus, that's an inflation tax. That has to be equal to the risk-free rate plus the risk premium you require from holding money. So if you aggregate risk, then there's inflation risk. No? There's also risk if there's inflation moving around. If the money supply stays constant, let's say, but the economy is shocked around and there's inflation risk. So that's the price of aggregate risk var sigma times the aggregate risk you're facing. Okay, so that's the risk premium, and that's what they require, and that's essentially what's paid off for. Okay.
Marcus, I have a small question. Shouldn't interest rates appear anywhere there for the money expected return?
So the risk-free rate.
Interest rates. I mean, I'm assuming that money is the same thing as bond here, and that pays some interest rates.
Yes, fair enough. So you have to this mu M, that should be this mu B checked. So it's a money printing paid beyond the interest rate. So
okay.
that's
thank you.
That's a good point.
Marcus, just to clear one point that you mentioned right now, it need not be the case that there is no inflation, right? Inflation needs to be deterministic. There needs to be no inflation risk.
That's correct. That's correct. So for inflation, if you're compensated for inflation, doesn't really, everything is in real terms here, okay? But the inflation risk is still, you still have to pay inflation risk. If you hold money, but if there's 5% inflation, you get 5% higher interest rate, you don't care, eventually. What you really want to be compensated for is this inflation risk you might potentially face. Of course, you will be compensated nominally also, but everything is here expressed already in real terms. And what we really want, so I expressed here everything, put everything in except for this check. I forgot this check here. We want the excess return, so I can just subtract, and you can see all of that's why the aggregate risk doesn't really matter. It all drops out in terms of excess returns. Okay. So let's just go through the set. If you then subtract it to what the big items which are showing up as an excess return is this dividend yield. If you hold money, you don't get a dividend yield. But then there's also difference in risk profiles and all this. Inflation tax shows up here. The money is subject to inflation tax, but physical capital is not. And then there's, of course, the most important component, or equally important component, is that money has no idiosyncratic risk, while physical capital has idiosyncratic risk. So as a first order, you could say the big difference between capital investment and money investment or bond investment. So if you compare what is the big difference between the two, it's on the one hand, you have, if you hold capital, you get some dividend yield, you produce something, but you also have to bear some idiosyncratic risk. Okay, that's the trade-off. Then as on top of it, there is also some other stuff which comes from the inflation, what the government is doing, how much the government is taxing thing. If the government is not doing anything, it's not printing money, nothing, all of these other things is switched off. But if the government is taxing by printing more money all the time, it's diluting the money and paying the seigniorage to the capital owners, then it also distorts things. But that's government activities. Okay. And then if we focus on stationary equilibria, or let me just say a few more words. This price of risks, what we did in this problem sets already. There's a price of aggregate risk, which is, showing up here. If you have log utility, it's just the volatility of your net worth. Remember, so with log utility, everything turns out very simple. It's just the volatility of net worth for this guy. And this is under consumption numeria. Okay. What you did, that's like this var sigma. Remember, this was a stochastic discount factor. We postulated a loading on DC or DC tilde on DC. So of course, this term is not here anyway because we have switched off the aggregate risk. What matters is the idiosyncratic risk. That's what's going on here. This was this var sigma tilde, and that's just with log utility. There's a so this white thing should not be there because it was, so there's gamma is 1 then, okay? With log utility, gamma is 1. And you see it's the sigma tilde n, how much does your net worth load on this DC tilde term? That's a sigma tilde n, and that's 1 minus theta times sigma tilde. Because you only 1 minus theta fraction of your wealth is in capital stock. So theta fraction of it is protected from idiosyncratic risk because you hold government bonds. Okay. So if you put all of this together in a stationary equilibrium, then there's no drifts in these Q's and the P's. So all of these other, so the iota, the subscripts T drop out, the Q subscript T's drop out, and all of these other things drop out. Okay. And then you can put market clearing conditions, as we did before in it. So you have capital markets clearing condition. That's what we first we said theta is equal to 1 minus is equal to var theta. Now it's just 1 minus. That's capital. Actually, what we did essentially is debt market clearing condition, which is theta is equal to var minus theta is equal to var theta. Here we do capital markets clearing condition, and the portfolio choice you put in capital is just given by this expression here. Okay, it's just solving. You just take this and solve it for 1 minus theta. So it shows up here. All of these other terms drop out in the stationary equilibrium, and just solve it 1 minus var theta, and you get this expression. So this is what fraction of your wealth you put into capital depends on the dividend yield. And if there's an inflation tax on money, you also put more in capital. Okay. If the idiosyncratic risk is higher, you put less into capital. You see? If the risk aversion is higher, you also put less into capital because you face this idiosyncratic risk. Okay, that makes perfect sense. I mean, you have seen this Merton problem. It's a standard Merton portfolio problem. It's just applied to this setting here. And then we have the goods market clearing condition. We have talked about that before, where the goods market clearing condition is, that's just rewritten this way. And if rho check, if you have volatility, rho check is equals to rho. And then you get this equation here. Just put these two things together, get 1 minus var theta is equals to square root of rho plus the money printing or the bond printing component. Now, if the government is not printing any bonds, so it's mu m or mu b is equal to 0, and if your log tilde is mu check is equal to rho, then I have essentially solved this whole thing. So gamma is exogenous, sigma tilde is exogenous, rho is exogenous, and I have essentially what this rho is, and I can plug it in, and I have then the whole equilibrium in closed form. So if I put this all together, I get this formulas here. So more generally, this holds for any constant relative risk aversion, but for log, rho check becomes an exogenous parameter, okay, equals to rho. And that's what it is. There are two equilibria, two stationary equilibria. It's only the stationary one, okay. There are two stationary equilibria. One is there's no, the value of money or the value of bonds is 0. And that's what you get in terms of the value of money, the value of a bond is 0. Hence, the value of capital is given by this. The value of one machine is given by this. This is again per unit of capital. Okay, so it's this P times K would always be 0. And this is the value of then if you're in a money equilibrium, when it has some value, it's given by this expression, and K is given, the value of a machine is given by this expression, and the iota is given by this expression. Okay. And you can see, you can solve it explicitly. I have to admit, so all these mu m's should become, there should become mu b's with a check on top. Okay. Now then we can look at this and get some sense for this. So the first thing is, are there any questions about this formula? So we got very excited. So there are many elements which make this work. Normally it didn't work so beautifully, but it works because of our adjustment cost functions and all this. And you can solve this explicitly. And it's essentially an Ayagari type model where there's physical capital and there's money. So in Ayagari, there's essentially money is driven out. There's only physical capital. And both, one has idiosyncratic risk, the other one doesn't have idiosyncratic risk, and you can still solve it in closed form. Okay, and you can put aggregate risk on top of it. You can still solve it in closed form with aggregate risk as if the aggregate risk is a particular form. Okay, are there questions about this one? And it makes, I mean, you see all the terms floating around. Of course, you can say I switch off the money printing or the bond printing, then this mu m is 0. Or you can say, whenever we print money on bonds, we pay it out to in form of interest to the bondholders or to the money holders, but then this also drops out. So this mu m is also 0. But I think the more interesting thing is, so I should say that the value of money, can anybody give me an idea? Money never pays any dividends. No, you don't produce anything with this government bond. So let's suppose we have an economy, we grow at 3%, the government, let's say the bond grow at 3%, or the money supply is growing at 3%, and everybody's willing to hold these bonds. Why is it the case? And there's no payoff from these bonds. Okay, they don't pay anything. So why is it the case that the bond has some value?
Because maybe because people want to insure against idiosyncratic risk.
Yes, so exactly. So they want to hold these bonds as a protection against their own idiosyncratic risk, and And that's why the bond has some value, but the fundamental value, if you were to say what's the dividend payment in real terms, it's 0 all the time. Okay. So essentially, it's a classic bubble. Now it's like an OLG model, but here it's a different setting. It gives you some it's a safe asset. So the safe asset feature gives it this particular form.
Marcus?
Yes.
Can it also be a reason that they might anticipate scarcity of the bonds, and that might lead them to hold them as well?
Yeah, this could also be, but if the bond is worth nothing in the future, it has to be worth something in the future, which always then drags on in further future and so forth. So, and the formulas also hold if the economy grows at 0. Okay, so if there's no growth rate in the economy. So it doesn't need to, so the scarcity argument is, it helps, it leads to a higher return, but why does the higher return not show up in the formulas? If the economy grows faster, the physical capital becomes more attractive and the bond becomes more attractive. Okay, because if the economy grows at 3%, you also get it by holding capital, because it also grows at 3%. It becomes, in a sense, more scarce. And the bond is the same thing. So in this sense, the relative return is not different between the bond and the physical capital if the economy grows faster. Okay. What's really the difference between the two is 3 things. One is the capital pays real physical output. There's some dividend yield, but it has this idiosyncratic risk. That's a bad thing. It's good for money. And then it depends what the government is doing. Is it, diluting, inflating the bond holdings away and gives it then to others? So then it will tilt towards physical capital. Okay.
Hey, sorry, Marcus, a quick question or comment there, because the other key role that normally money or liquid bonds play in the purely Ayagari literature is that, binding constraints. You don't have that mechanism in this model, like individuals don't have a borrowing constraint.
There's no borrowing constraint. They can.
Like the techniques here, could that be used in that setting or no?
Yes, you can put it in. Of course, here, so it's a very simple setting that they're all the same. So not everybody can be borrowing. So if you want to have a borrowing constraint, you need heterogeneity. I mean, we have heterogeneity within the sector, but we all scaled up versions of each other. No? So our portfolio share is always 70% capital and 30% money. And nobody is short money. Nobody is borrowing here. Okay. So once you want to do this, you need more than one type of investor. Here we have only one type of investor. We need 2, 3 or something. We can do this too, but then you can't solve it in closed form anymore. But you can already show something. So for example, is that money is a bubble or this bond is a bubble. It never provides any value, but any physical payoff or dividend payments. What it does, though, it provides a good store of value. It's a safe asset. Okay, so it's just a way to protect yourself against your idiosyncratic risk. The other thing is, what's interesting, if you do some comparative static with respect to sigma tilde, the idiosyncratic risk on the x-axis here, what's interesting is that if idiosyncratic risk is going up, that means the value of the price of a machine is going down. That's the red line here. But the value of money or of the bond is going up relative if you make it proportional to K. Okay. So this QB, which is the value of the bond, goes up when there's more idiosyncratic risk, while this QK falls when there's more idiosyncratic risk. There's a flight to safety. Okay. I think this flight to safety is very prominent in the data, and you get this in this model. So whenever the idiosyncratic risk is going up, people say, oh, I have 70 in capital, 30% in money. I want to now move to 60-40. And even though the uncertainty goes up, everybody's rushing into the dollar, is rushing into some safe asset. Okay. And of course, you can extend this model. So if I assume that the stochastic the volatility is fixed, you can make it a stochastic volatility where the volatility itself follows a stochastic process. Okay. And then you get this, then you automatically move back and forth and you get the same the intuition you get from this comparative static exercise, you get in a fully dynamic model then. Okay. Let me jump over that. So what's my time? I think Atif is coming at 2:45. No, is this correct? Guys, do you have a plan?
Atif is supposed to start at 2:45.
Okay. So essentially, I'm running out of time. So let me just say a few words. What I want to say a few more words. What this model shows, it's a simple, elegant model where you can actually derive the value of money explicitly. And you can also show that money is a bubble, and you can actually then show why does transversality condition fail. Also, typically, you say, oh, typically a transversality condition, or it's because you individually discount differently than somebody who is an aggregate player in this economy. So individually, the transversality condition holds, but for the aggregate economy, it doesn't hold, because in the aggregate economy, there's no idiosyncratic risk. There's not even an aggregate risk if you take it out, but each individual guy faces on top of it idiosyncratic risk, and hence he behaves differently. So the transversality condition holds individually from person to person, but not at the aggregate scale. Okay, that's where the big insight comes from, why there can be a bubble in this setting. The other thing I would like to say, by printing this money, then it's actually the case, if I print this money, I can generate seigniorage. I can actually milk this bubble, or can mine this bubble. Okay? So I print some of these bonds, and from this I can generate wealth and can give it to the capital owners or whatever I want to do. Okay. And this is a little bit like MMT, modern monetary theory. So I can issue more and more bonds without destroying the economy, without destroying the bubble, and I can actually essentially tax the bubble. So I'm going on a big picture here. And because I can tax this bubble, I get some sense, in some sense, I can, subsidize certain parts of the economy. Okay. So essentially what I do is I have a bubble. As a government, I have a bubble. I can actually issue new bubbly bonds or new bubbly money. And then from this, I get resources. I can do something with these resources. I give it away, or I'll do something else with that, or throw it into the sea. But without destroying the bubble, if I don't do it too much, I can actually keep on the bubble going. And this way, I can actually get resources without paying this. Why is that? Because the money or the bond itself has some social value. The social value, it allows, that's a key insight, it allows us to insure ourselves to some extent. So that's what I would like to end up with. And so what's important is that we have a major friction in this economy. The major friction is that we cannot share idiosyncratic risk. Okay, that's what the problem we are facing. So what should I do in order to fix this idiosyncratic risk? One way to fix this idiosyncratic risk is to say I offer an aggregate bond, some government bond or some government money, and by offering this, we can share some of our idiosyncratic risk. Okay, so this allows a partial sharing of idiosyncratic risk, and this bond provides this service. The government bond provides this service, and for this service, you can charge something, and you can actually tax for this service. So that's what the government can do. So it's essentially is mining this bubble, because the bubble has some service. It doesn't pay off any payoffs, because it never pays any payoffs. It might be even negative payoffs because the government might tax it, but it provides a service by ensuring idiosyncratic risk to some extent. Okay. So like in the old G setting in Samuelson, if you introduce a government bond, it allows some transfers, some trade across generations, even though they're only overlapping generations, but they can trade with the new bonds, yet we can already do something. Here it is the same. It is the case that we have now a situation because of the bond, we can partially share our idiosyncratic risk, and that's the service the bond provides. And that's the service I can tax, and from this actually the government can siphon off something. And that's why the fiscal of the price level, which typically assumes the intertemporal government budget constraint has to hold, here's an extra term coming in, a bubble term come into play, and that creates extra revenue, and that can explain why, for example, in Japan, if you look at the Japanese picture, so that's like the fiscal of the price level. The fiscal of the price level says, okay, if the government has some, it has to have some discount of future primary surpluses have to be positive for the bubble, for the bond to be of some value. But in our setting, it could be a bubble value and the bonds still have value. So that's why you don't see in Japan hyperinflation and huge inflation, even though the government debt to GDP ratio is very, very high. Okay. So let me summarize this in a big picture. So what we did yesterday, we did a huge model with two sectors. This was a toy and was also in the form of a toy model because there was only one sector could invest and the other sector could not invest. You could not issue equity. So there was many simplifications. But there was no idiosyncratic risk and there was no government money. It was a real model. So today, what we did is, okay, let's look only in one sector. Everybody is similar in this one sector. There might be just scale-up versions of each other, so we can aggregate nicely within this sector. But now we have idiosyncratic risk, and we cannot share this idiosyncratic risk, okay, because of financial frictions. But once we introduce money or some bond, we can partially share this idiosyncratic risk. And that gives the bond, even though it's fundamentally never paying off anything, it gives the bond some value. And this value we can derive explicitly in closed form. We can use the same solution methods we have and have a new theory, essentially, how the value of money is derived in this setting. And then they say, okay, because of this value, this service this government bond provides, the government can actually siphon off some of these benefits by taxing it. And how do you tax it? Essentially, you print more money and dilute the bond holdings. It's an inflation tax. And this way, you can fund part of your budget deficit of this, and that undermines essentially the fiscal of the price level assumption that, you know, it has to be an intertemporal budget constraint, and that's where this fiscal of the price level equation comes from, because they don't have this additional bubble term which appears in this type of models. Are there any questions? And I was rushing a little bit too much at the end concerning this model. It would be good if you...
Hello, Marcus. Can I ask a question?
Sure.
So, so in this one sector model, because we only have capital, then when there's a recession, so there's when investment is lower than its efficient level, then we should see consumption going up, right? Because there's no labor and wage. But you know, in the RBC model, when we see a recession, then consumption, investment, and employment, they contract at the same time. So I'm just wondering, because you are talking about policy, how much the intuition will carry on if you take this into account?
No, if you want to have this distinction, you will have to have a labor sector as well. So we didn't put the labor sector in, as we have some first drafts on this. Indeed, so what I did today, essentially I compared two steady states. So it's about the long-term growth rate of an economy. So it's like, do you want to have you know, do you want to stimulate? It's not about stimulating with respect to cycles. For that, you have this flight to safety I was alluding to. That's a comparative static. So I did a comparative static exercise in that. But it's indeed correct what you said. Total output is given by the current capital stock. There's no unemployment. So if you want to have an unemployment effect and other things, that output shrinks because suddenly there's unemployment, and that's you know, what's going on in the real world. For that, you have to have a labor sector on top of this model, and we don't have this in the current juncture.
Yeah, would you expect some of the intuition carry on?
Yes, so the main intuition will still carry on. So the main choice, the portfolio choice, will still be there. This will be this flight to safety when you go in a recession, and often a recession happens when uncertainty is going up. So typically uncertainty is going up, including idiosyncratic risk is going up. People shift their portfolios out of the risky investments into some safe assets. And this shift then will shrink the whole economy, leads to lower investment, lowers growth rate. And in the current framework, if you have less investment, you have to put it somewhere, you put it in consumption, but in general, it would mean there's less investment, there's also less labor demand, and that drags the economy down even further. So it would make the whole thing more dramatic.